Okay, so you sent over this really detailed report on the global economy.
Hmm.
And honestly, it's the kind of thing that can make your eyes glaze over, you know?
Ha! Yeah, they can be dense.
Totally.
Yeah.
So what we want to do today is like pull out the really crucial bits, the stuff that actually matters day to day about trade and interest rates, all that interconnected stuff.
Exactly.
The goal is just to make sense of it for everyone listening so
Yeah.
they can see how these huge global shifts might, actually touch their lives, their wallets.
That's the plan. Think of it like a snapshot, right?
Okay.
A snapshot of a world that's moving really fast. You've got countries rethinking trade.
Yeah, the U.S., China, EU.
Right. And central banks doing this tightrope walk with inflation. It all creates, well, a lot of unpredictability.
So we're connecting the dots, basically. High-level trends down to, like, your bank account.
Precisely. Connecting those trends to what you might actually be seeing and feeling.
All right, let's dive in. Interest rates. That seems like a good place to start, and it keeps coming up.
Well,
The report says central banks, Europe, UK, Canada, they're thinking about lowering rates. What does that actually signal for someone, say, with a mortgage, or maybe thinking about a car loan?
okay, so when a central bank cuts its main rate, it gets cheaper for commercial banks to borrow money.
Right.
And usually they pass some of that saving on. So yeah, for you, it could mean a lower monthly mortgage payment down the line, or maybe a better rate if you're financing a car or getting a personal loan.
So cheaper borrowing.
Potentially, yes.
Yeah.
And the report actually pointed out a little recovery, a slight uptick in mortgage activity in the euro area and the UK.
Oh, interesting, like an early sign.
Could be an early sign that the possibility of rate cuts is maybe starting to filter through.
Okay, that sounds good if you're borrowing. But what about the flip side? Savers. Does this mean, the interest on my savings account is going down?
Generally, yes. That's usually what happens. Lower central bank rates tend to ripple through to lower rates on savings accounts.
Right, because they want you spending, not saving.
Well, it's part of the mechanism, yeah, to encourage spending and investment in the wider economy.
Makes sense. The report also dug into inflation, and it sounds like it's a different story depending on where you look.
Very much so. It's quite varied.
Can you give us the sort of quick global tour on that?
Sure. So in Europe and Canada, the headline inflation rate, the main number you hear about, seems to be cooling off more clearly.
Okay.
Canada, for instance, their latest inflation numbers actually came in lower than people expected.
Which gives their central bank more room to cut rates.
Exactly. More confidence to potentially make those cuts. But the U.S. and the U.K., it's a bit stickier there.
Stickier.
Yeah. The report talks about sticky services inflation.
Okay, sticky services inflation. That doesn't sound great. What does that actually mean? Like in terms of stuff I buy?
Think about services, right? Getting a haircut, eating out, repairs, that kind of thing.
Okay.
The prices for those don't tend to jump around like, say, gas prices or fruit. They're stickier, and they're really influenced by wages.
All right, wages.
And in the U.S. and U.K., wages have been rising pretty strongly. That pushes up the cost of providing those services.
Which keeps overall inflation higher for longer.
You got it. Makes it
Yeah.
more persistent, harder to bring down. The report even mentioned that in the UK, payrolls, the number of jobs, actually fell, but wage growth is still really high.
Wow. So, okay, the central banks want to lower rates to maybe boost the economy.
As things are slowing down, yes.
But they're worried this sticky inflation, especially in services, will just hang around
Yeah,
or even get worse.
that's the balancing act. It's a real dilemma. Lower rates can help growth, make borrowing cheaper for businesses to invest and hire.
Yeah.
But if inflation stays too high, your money just doesn't buy as much. Your paycheck doesn't go as far.
Erodes purchasing power.
Exactly. So they're watching the data like hawks, trying to figure out the best time and how much to cut without letting inflation take off again.
Okay, let's switch gears. Trade wars, another big theme. The report talks about U.S. tariffs, cars, semiconductors, even pharmaceuticals, and then China and the EU hitting back with their own tariffs.
Yep, a major source of uncertainty.
How does this stuff, these big international disputes, actually filter down to the prices we pay?
Right, this is where it hits the household budget directly. Take cars. If the U.S. puts a tariff on imported cars, it's like adding a tax.
Okay.
Now, maybe the foreign car company absorbs some of that cost?
But probably not all of it.
Probably not. It's very likely a chunk gets passed on to you, the buyer, higher sticker price at the dealership.
And the report mentioned car companies were actually relieved when temporary exemptions were discussed.
Yeah, which shows you just how much those tariffs worry them, how sensitive prices are. They know it affects sales.
But cars could get more expensive. What about electronics? And medicines were mentioned too.
Same logic applies. Semiconductors, the chips in everything from phones to cars, they're also targeted. And even if some gadgets get exemptions, the supply chains are so global and complicated.
That tariffs can still mess things up.
Exactly. Disruptions can cause delays, maybe higher costs anyway. And pharmaceuticals being looked at for tariffs under, quote, national security.
Yeah, that sounds worrying. Could mean higher drug prices.
It raises that concern, definitely. More expensive prescriptions.
Man, it's pretty sobering how these big trade fights can hit us right in the wallet for essentials. The report also mentioned supply chain shocks. What's that about?
Okay, imagine a product needs parts from, say, 3 different countries before it's assembled in a fourth and sold in a fifth.
Sounds pretty normal these days.
It is, but tariffs can throw a wrench in that whole flow, create bottlenecks. That's a supply chain shock.
So like a delay in one part holds everything else up.
Precisely. If the U.S. tariffs, a key component from China, needed for a product built in Vietnam for Europe, the whole chain gets disrupted. Delays, higher costs at each step, potentially.
Any example?
The report mentioned China suspending deliveries of Boeing planes. That's a huge disruption, showing how quickly these disputes can impact massive business operations.
Wow. Okay, that sounds like a nightmare for companies trying to plan anything.
Yeah.
Does this push them to, like, bring production back home? The report mentioned reshoring.
It definitely makes them think about it. Reshoring, moving manufacturing back to the home country, is gaining traction as a way to reduce that risk from trade tensions.
Does it work?
Well, the report suggests for some sectors, maybe, like U.S. chip makers getting government help or car companies that already build a lot domestically.
Could mean more jobs here, potentially.
It could, which is a plus, but, and it's a big but, production costs might be higher back home. And those higher costs could eventually mean
higher prices for us anyway?
potentially, yes, could even contribute to inflation long term. So it's not a simple fix.
Complex trade-offs. Okay, so all this uncertainty around trade,
Mm-hmm.
how's it affecting businesses overall, their confidence? Are they still investing?
Yeah, the report definitely signals a hit to business confidence, especially seeing dips in places like Germany, the UK, and also among smaller businesses, SMEs in the US.
Why? Just the uncertainty.
Pretty much.
Yeah.
If the rules of trade can change suddenly, why would you make a huge investment in a new factory or lots of equipment?
Yeah, you hesitate.
You'd hesitate. You're unsure about the cost of your imported parts or whether you can even sell your stuff easily in other countries later. Big investments get put on hold.
Makes total sense. It's hard to plan when things feel unstable. But, are any industries actually doing okay in this? Or maybe even benefiting? The report hinted at some potential winners.
It did suggest a few areas, yeah. Like we mentioned, U.S. chip companies getting support to build more domestically. They might have an edge, reducing reliance on foreign suppliers.
Right.
And maybe car companies that already have strong manufacturing bases inside the U.S., they might be less exposed to import tariffs, could even gain a bit competitively.
Interesting. So pockets of opportunity maybe amidst the general gloom. Let's shift to financial markets. The report called it a roller coaster ride. What's been going on with stocks and bonds?
Roller coaster feels about right. A lot of ups and downs driven by these fears about trade wars, policy uncertainty, what the central banks might do next.
So investors are nervous.
Seems like it. We saw, European and UK markets holding up okay more recently, but in the US, the S&P 500 was down for the year at the time of the report.
And the NASDAQ, tech stocks, all that AI hype.
Even the NASDAQ, yes, saw pretty significant losses despite the AI buzz. Suggests investors are maybe getting more cautious about future profits for those big tech companies if trade gets tougher.
Okay, what about bonds? We hear about bond yields going up or down. Can you break that down simply? What are yields and how are they reacting?
Sure. Think of a bond yield as basically the return you get on lending money, usually to a government or a big company. It's the interest payment relative to the bond's price.
Okay, the return.
Right. And when investors get nervous about the economy, about trade wars, they often rush to safer assets. Government bonds are seen as safe.
So lots of people buying bonds pushes the price up.
Exactly. Demand goes up, price goes up. And here's the key thing. When bond prices go up, their yields go down. It's an inverse relationship.
Got it. Price up, yield down.
And the report noted U.S. Treasury yields did exactly that they initially rose on inflation worries, but then fell as trade war fears got worse. People were seeking safety.
Okay, that makes sense. Nervous money flows into bonds, pushes yields down. What about currencies? Dollar, euro, pound. How are they bouncing around with all this?
Yeah, trade fights and different central bank moves definitely cause currency swings. The report mentioned the U.S. dollar had weakened a bit.
Why is that?
Partly the trade tensions, maybe investors feeling a bit less certain about the U.S. outlook, a bit more risk-averse generally.
And the euro, the pound.
They'd shown some strength,
Ah,
possibly because markets were thinking differently about future interest rate moves over there compared to the Fed.
and this matters because,
Well, currency moves affect the price of imports. If your currency weakens, stuff you buy from overseas gets more expensive.
right, and travel too, I guess.
And international travel costs, yeah. A weaker dollar means that European vacation costs more. Tangible impact.
Okay, got it. Let's touch on commodities. Raw materials. The report mentioned oil prices fell. Why, and what's the impact for us?
The main reason oil prices dropped was basically lower expected demand globally. Big forecasters like the IEA and OPEC cut their predictions for how much oil the world would use.
Because of slower economic growth predictions
Mm-hmm.
and the trade worries,
Exactly, tied to those factors. For most of us, the direct impact is usually lower prices at the gas pump.
which is nice.
Definitely provides a bit of relief for the household budget. But, worth remembering, lower oil prices can be tough for economies that depend heavily on selling oil.
Right, double-edged sword. What about other commodities, like metals used in industry?
Yeah, the report saw softer demand there too, things like copper and steel.
Why is that?
Again, linked to slower global growth expectations. Less construction, maybe less manufacturing activity expected, especially thinking about China, which uses a lot of industrial metals.
Does that affect me directly? Like gas prices?
Probably not as directly or obviously. It's more of an indicator of slower activity in big industries like construction and manufacturing, which could eventually filter through the economy.
Okay. And lastly, the big one for the grocery bill, food prices. What's the outlook?
Some slightly better news there, maybe. The report suggested food price inflation, the rate of increase is starting to moderate, to slow down.
Oh, good, after those huge jumps.
Exactly, a welcome sign, but. There's always a but.
Oh,
The report added a note of caution. Things like bad weather or more trade disruptions, those could still cause problems, make food prices volatile again.
so maybe easing, but keep an eye on it.
Pretty much. Still an area to watch closely.
Okay, this has been super helpful, really breaking down these big global forces. Looking ahead now, what are the main things we should be watching? The key signals or risks?
Well, the report really flags the interconnectedness of it all. You need to watch the trade tensions. Will they escalate further?
Right.
What will the central banks actually do with interest rates? And how will inflation behave, especially that sticky services part in the US and UK?
So those three things mostly: trade, rates, inflation.
They're tightly linked. And one specific risk mentioned was something called tariff whiplash risk.
Tariff whiplash. Sounds painful.
Yeah, it paints a picture, right? The danger of sudden, unpredictable tariff hikes that could just jolt the economy, hit prices fast, and really damage business confidence.
Okay, so watch out for sudden policy shifts. Anything else? Any wild cards?
The report also points to what it calls geopolitical tail risks. Think, major flare-ups in places like East Asia or the Middle East.
Things outside the purely economic sphere.
Exactly. But things that could suddenly impact energy prices or scramble supply chains in a big way. Unpredictable, but potentially high impact.
And one more thing for the US and UK.
Yeah, that concern about a potential wage price spiral where higher wages keep pushing up service prices, which leads to demands for higher wages and so on.
Making it really hard for the central banks to get inflation under control.
Precisely. That's a lingering worry in those economies.
Wow. Okay, so it's definitely a complex picture, lots of moving parts. If there's like one core message for listeners, something practical to hold on to from all this.
I think the main takeaway is just how connected everything is. These big, abstract, global trends, trade deals, central bank decisions, they really do have tangible effects on your everyday life.
The mortgage rate, the price of groceries, gas.
Exactly. The interest on your loan, the cost of goods, filling up the car. So it's actually worthwhile, paying a bit of attention to news about trade policy or what the latest inflation report says or what the central bank in your country is signaling.
Because it shapes the world we live in, financially.
It absolutely shapes the economic environment we're all navigating. This deep dive gives the overview, but hopefully it sparks some curiosity to keep exploring how these forces work.
That's a great way to put it. Understanding these forces helps us make sense of the currents shaping our own lives. Thanks so much. This has really cleared up a lot.
My pleasure. Glad it was helpful.